Most traders know how to enter a trade. What they don't know is which direction they should be trading in. In this video, I'll show you the exact multi-time frame analysis framework I use to identify trend, structure, liquidity, and where every major move begins. You won't have to waste hours looking through years of chart data. I will show you how to quickly focus on what actually matters and ignore the noise. I don't want to waste your time mapping the chart from scratch. Instead, I will explain exactly how I mapped everything from the monthly chart all the way down to the 15-minute chart. And each level matters. My name is Jamal, and welcome to FOREXSOM. Now, let's get into it. All right, here we have GBP USD, Pound USD, known as cable. Now let's go to the monthly time frame. If you go to the monthly time frame, I just want you to forget about everything from here all the way here. This is from we're talking about from 1971 to 2021. Forget about everything from here all the way down. That's too much data. You don't need none of that. What we're going to be focusing on from here to here. What's going on from here to here? We are in the present moment. This is what we need to be focusing on, okay? All right. Now on the monthly time frame, if I zoom, we can clearly see what's going on over here. We have market coming down, creating a pullback. We can see the candle trading above this candle high, and then we have moved to the downside. The color of the candle does not matter. As long as the candle trades above the previous low, we have a pullback already. If I turn into a line chart, you can see the pullback right there, and that's one secret that you need to know. Okay, we have a change of character. After that, we have a higher low, higher high, higher low, higher high, higher low, higher high, higher low, and higher high, which means this is clearly an uptrend market structure. You can also see after I marked every break of a structure, I also marked a liquidity. This is what we call an inducement. This is what we call an inducement. You can see after the higher high, the market came down, created the first inducement, which is the first pullback, and then took out, price reversed, continued, going to the upside, creating a break of a structure, another inducement, coming down, taking out the inducement, reversing from a demand zone, continuing, creating higher highs, another inducement, reversing, and then tapping on a imbalance / demand zone, and then continually creating higher highs, higher lows. Okay. Now that we identified that we have high highs, high lows, which is an uptrend market on the monthly time frame, now we're going to go to the weekly time frame. Once you go to the weekly time frame, everything becomes a little bit clear. We can see the change of character very clearly. We can see lower high, lower low, lower high, lower low. And then we have price trading above the previous lower high that led to the lower low. Now we have what we call a shift in trend, which means we have a change of character. Okay, you can just call it a shift. So now we have a higher high, we have a higher low, and then we have a higher high. In between, we have what we call an inducement. Inducement is what the smart money traders create in order to trick or incite the retail traders. They create a fake move because most of the traders think that the market created a higher high. They get to mark their demand zone over here, thinking that price is going to reverse from here, but that is not what's going to happen. Okay, that's not what's going to happen. This is just a inducement in order to induce the retail traders into getting to the market early. This is why you need to know how every move begins and where it begins and what liquidity means. All right, so we have a higher high, we have a higher low, and then we have a higher high, which created a break of a structure. After the break of a structure, we can see the first higher low. The first higher low is taken out as an inducement. Most traders, like I said, they might end up taking a trade from here, but that does not work. So you have to understand where smart money traders use to induce the retail traders. Every high is approved after we have an inducement. This is very important. All right, we have price coming down and then reversing from a demand zone, creating another higher high right here, breaking structure. So we have higher low, higher high, which created a break, which created a break of a structure. Okay, we also have an inducement. After the higher high, price came down, took out the inducement, tricked the retail traders, because they thought that they were going to enter here again. Market fails them again, takes out their stop loss. Price comes down and then reverses from an area of demand zone. We have another higher high, creating a break of a structure. We also have an internal liquidity / inducement that was created right here after the break of a structure, meaning this is a valid break of a structure or valid high. All right, so the inducement was created. Retail traders are literally induced, taken out. The stop loss was taken out. Now, smart money traders moved, entered the trade again, continuously going higher highs. All right, now let's go to the daily time frame. You can go by day, weekly, 6 days, 5 days, 4 days, but we're going to jump into the daily time frame. Once we move into the daily time frame, we can see a few things. Very clear. We have a higher high, inducement was created, price came all the way down to a demand zone, and then creating a higher high. We can also see that market reacted once the market took out the inducement or liquidity here after the break of a structure on the daily time frame. We can see price reacting around this area because there was some sort of inducement that was taken out here, and there was an empty unmitigated supply zone / imbalance right here. So price reacted right away, creating a shift around this area. We can see the shift. Price taps on the higher time frame unmitigated supply zone, but our main bias will be a buy market because we identified from the higher time frame that this is an uptrend market. Okay, so we have a mini shift, an internal shift here. Price came all the way down with the pressure, went back again, creating a imbalance between here and here. We can see the imbalance going on, and then price reacted right away. This is where we use what we call probability versus possibility. So we have two choices. We know the overall market is an uptrend, but we might experience a short-term sell. We can see the mini change of character that happened after price tapped on the unmitigated supply zone from the higher time frame. This is just a temporary change of character. We can see price reacting to it, creating an engulfing, and then reacting to it right away. All right, now let's continue going to the 4-hour time frame. If you go to 4-hour time frame, there are two choices here. There are two options that we have. The first option is price reacting to this area. Price reacting to this area because we can see the imbalance. We can see the shift, the temporary shift that happened on the daily time frame now becoming more clear. We can see price reversing back to it around this supply zone area and then creating a mini change of character within. So it tapped on this supply zone, internal supply zone. We might see a reaction to the downside for a little bit, and then we might see a reverse. So right now our bias is maybe sell for a short term, but then once we find once we end up on a higher time frame area of demand zone, we're going to be interested in looking for a buy market. Again, we can see there's some sort of imbalance going on here. So price might trade up to right here. Price might come all the way down here before we see a continuation to the upside. Price might trade until down here before we see a continuation with the higher time frame overall trend. All right, but for now, we might end up looking for a short sell from here to here. Technically, this is 546 pips. This is why I told you to forget about the entire data on the left, because that's too much data. You don't need that much data in order to get a 80 pip, 60 pip, 50 pip trade. All right, so we might see a trade from here to here, which is 543 pips, which is a 540 pips, okay? And then we might end up reversing from here and continue with the uptrend on the higher time frame. All right, so the 4-hour time frame. On the 4-hour time frame, if I get back to it again, we can see price creating high, 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 low, and then higher, high, and then creating a change of character. We can see also a reaction going on over here, and this reaction might be a continuation to the downside. Continuation to the downside. It can also go all the way up and continue trading with the overall trend and use this as a liquidity. That can also happen too. But right now, we cannot ignore this short-term change of character. We cannot ignore this, and we cannot ignore this liquidity that was taken out within the 4-hour time frame. We cannot ignore this liquidity that was taken out on the 4-hour time frame. We cannot ignore this rejection that happened here on this candle here. So this is a valid supply zone within the internal structure. If you can see, this area took out liquidity. This candle took out liquidity. You can see it took out liquidity of the high of this candle, and then pressure came in. Price was pushed from the buyer's market, and then sellers came into the market. They started pressuring the price downside, and then created some sort of inducement / liquidity, and then price continued to the downside. We can also see this liquidity or / inducement is already taken out. Price reacted to this supply zone. Now let's go to the 1-hour time frame. If you go to the 1-hour time frame, you can see a clear imbalance / supply zone. Remember, supply zone, order block, same thing. Demand zone, order block, same thing. This is order block, means where the orders are fulfilled. Supply zone is where the sellers come in and look for entries to the downside, and demand zone is where buyers come in and look for a buy position. Order block, this and this all are terms. Don't waste your time learning all these concepts. All you have to focus is supply zone, demand zone, imbalance, break of structure, change of character, and direction. That's it. You don't need none of these other terms. It's just the made up names to make it more fancy. So you don't need to waste your time on this sort of behaviors. So we can see price reacting around this zone. We're not just going to blindly enter a trade right away. You could enter a trade when the price was around here. This is what we call a passive entry, but this is already moved a lot. So if you enter a trade later on when the market opens, this is already moved 40 pips. And your entry, if it's going to be right here, that means your stop loss will be way, way, way bigger than you think. Now let's go to the 15-minute time frame and see what's happening. Okay, the 15-minute time frame, we're going to wait for a shift. We're going to wait for a shift. If we get something like this and then back here, then we can go ahead and look for an entry to the downside. Okay, if price breaks above this zone, then we're only going to continue buying, okay, with the overall trend. But in this case, on the 4-hour time frame, we identified an internal shift of market structure, meaning we have we are expecting a short-term sell. Okay, you can see the 15-minute time frame. We checked it already. 15-minute time frame. We can see price creating low highs. 5-minute time frame. We can see price still creating a, still pressure to the downside. We have a major area that might create a reaction. Price might react around this area a little bit and then continue to the downside, or price might just tap on this zone and then they might be buyers coming in right away and continue with the overall trend. Both of these scenarios can happen. Remember, your job is not to predict the market. Your job is to play the game of probability versus possibility. Based on your knowledge of the technical side of the market, the fundamental side of the market, you're basically analyzing the historical data, looking at the past, present, and then thinking about the future. It's nothing is 100%. The market is always about flipping a coin. No one knows the exact direction of the market 100%. This is why your strategy cannot be 100% right. You might get like 60%, 70%, 75%, 80% maybe, but most traders, professional traders, their strategy is between 40 to 60%. This is exactly what their strategy is. All right. So in this case, we are expecting a short-term sell to the downside. If that does not happen and we break above this zone, then we're expecting a continuation to the upside. We're expecting a continuation to the upside. And that's how you analyze the market from the monthly time frame, to the 15-minute time frame. Like I said, you forget about everything from the rest, from here all the way to the left. Forget about it because that's too much data. And you only focus on what's going on from here to here. You look at this data. What is this telling you? What is the story here? To rehearse, you're only going to be looking at from here to here. And then you're going to go to the weekly time frame. Look at everything clearly. You can see, remember, before every major move, there is always an inducement that needs to be taken out. Let me show it to you how it looks like here. Okay, let's say this is a trend, okay? So we have a break of structure. Remember, the first higher low is always the inducement. Okay? The first higher low is always the inducement. In order to verify this high, we have to have an inducement taken out between here and here. There has to be an inducement. The break of structure happens. So once we have the break of structure, we have to have an inducement. This is where most of the retail traders get trapped because they think that market created a higher low. They will be taking a trade here. And this is where they get trapped. They put their stop loss over here. They get induced. Smart money traders, they continue pushing the market to the downside and then induce all the stop losses that's sitting over here and then reverse from a premium, from a discount zone. They never buy from here because this is too expensive for them. They want to buy it all the way and get it a discount price. This is like an expensive price. They want to get it a discounted price so that they can profit and make money. So you have to think about in terms of buying and selling eggs. Okay? If you want to buy an egg, let's say if you want to buy an egg, $1, and then you went up to $5, would you rather buy it at a $5 or buy it at a $2? Okay? The $2 obviously is where you're going to be profiting because once you buy it from $2, price goes to $7, and then now you are making $5 in profit. If you buy it from here, this is already too expensive, so you're not going to make no profit. So think about buying and selling eggs, whatever it is, anything. It's all about supply and demand. Supply and demand. Buying and selling. Buying from a discounted price for a discounted price and then selling it at a premium price. That is how the market is engineered. By the way, we are expecting a short-term sell from here to here and then continuation to the upside because the market is an uptrend. ideologically. Thank you guys again. My name is Jamal. If you haven't subscribed, please consider subscribing. Like this video, share this with your friends. If you have any suggestions of what kind of video I should make next, please put that in the comment section down below. I've been very busy lately. YouTube is not my only thing. I trade. I do other stuff. I have other business that I run, so I'm always busy. I try to make sure that I have you guys in mind, and this is me appreciating you guys again. Thank you so much. Until next video, stay profitable. Peace.